not only do the prices of the assets which you've been fixing begin to collapse under you, but the currency goes with it. And when it does, it happens very, very quickly. And I think we're probably, if there is an identifiable point where the mechanism now starts for a total currency collapse, given that all central banks are about to print massively just to support their economies through the coronavirus, and also to stop all the supply chains falling apart, then we're looking at the destruction not just of financial asset values, but we're also looking at the destruction of the currencies in which they're priced.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest, always well anticipated by our viewers, and they've written lots of questions for him. We have Alasdair Macleod, Head of Research at goldmoney.com. He joins us this Monday, April 13th, 2020. Alasdair, thank you for joining us.
That's my pleasure, DK.
We have a question from many of our viewers because they've been watching the major equity markets stumbling and staggering. They don't know if we're going to be rocking back into a V-shaped recovery and afraid of missing out on that. Are we back to times as usual? Have they been in the past buoyed by central bank goosing the markets? Or in fact, is this the eye of the storm and we've had the first real warnings of a major crushing bull market, and we're about to get hit with the other punch on the other side? So if you could at first, I know you're not here as a market predictor, but if you could give us what your research leads you to believe about what's coming ahead for people so that they can make informed decisions, give them the benefit of your perspective on that.
Yeah, sure. I think the first point I'd like to make is that before the coronavirus suddenly upended our world, the global economy was already tipping into recession. I mean, don't forget that liquidity strains were beginning to show in the repo market back in early September. And ever since then, the Fed has been injecting money into the banking system, initially through repos, but that seems to have ceased recently, and more now through QEs, or outright purchases of securities. And that seems to be a situation that's going to continue. But just chucking money at the problem of declining economy actually doesn't resolve the situation. It's not just a liquidity squeeze. What you have, if you like, is the periodic downturn in the creation of bank credit. And you've got to look at it from a banker's point of view. And bankers lend money, and when they lend money, it's out there at risk. If they perceive economic risks tending to increase, which was the situation before the coronavirus, then they tend to try and draw in their horns and lend less money. But on top of that, I mean, we had a situation where the U.S. government was accelerating its deficit, and the primary dealers had to absorb increasing amounts of stock, while at the same time you had U.S. hedge funds basically stripping out the interest rate differential between euros in particular and dollars by taking positions in the FX swap market. Now, these positions are actually very, very large. We don't know how large they were because they are a component of the total FX swap market. But suffice to say that the strains hitting the banks, and particularly the globally systemically important banks who have to have sufficient cash resources on their balance sheet to meet expected 30 days obligations. You can see that sort of combination of events led to a liquidity problem in the market. Then we got hit by the coronavirus, and that gave us a second problem, and that was disruption of supply chains. And if you look at supply chains just in America, the total value of those supply chains is around about $38 trillion. That is reflected in the gross output statistic rather than GDP. GDP is a lot less, at $21 trillion or so. Now, we can see that there's disruption in the supply chains, And the problem then is that if you disrupt a supply chain, you disrupt the payment flows that go with it. So notionally, what the Fed is trying to do is to rescue all the supply chain payment failures, as well as deal with the coronavirus. So we have a situation where the Fed basically has to print as much money as it takes, and it's infinite. Now, the thing that matters in this, if you're looking at the supply chain angle alone, is that we're looking at $38 trillion in an economy of only $21 trillion. So how many times has the central bank, the Fed, got to expand its balance sheet to ensure that the supply chains don't fall over? And even if they achieved that, you've got a problem with the supply chains abroad, because feeding into those dollars supply chains in America are imports of products, either, well, really, supply chain products. I mean, they don't necessarily come in as just pure end manufactured consumer products. I mean, you've got an awful lot of bits and pieces that go into motor cars and trucks and electronics bits and iPhones and all the rest of it. It is a huge problem. It's not just America. And if you add to that, there's probably another 40, 50 trillion of dollar supply chain outside America. Now, who's going to print all the money to stop all that falling over? That basically, DK, is where we are. Now, coming back to your basic question about what happens to stock markets, it's very much in that context. Stock markets, on any basis, are pretty highly valued. I don't know what the S&P is, somewhere between 25 and 30 times, I suppose. But that was before the coronavirus, and of course, earnings are going to be dropping very substantially as a result of that. You can make up your numbers. So, we're probably looking at S&P P of infinity, because the losses are just going to be so tremendous. And this really does make me think that looking at stocks rationally, we are in the early stages of a bear market, because people are only just waking up to what is involved. When they have woken up to what's involved, generally that is the end of the bear phase. I think this process of realization has got a lot further to go.
Interesting. Yeah, that's what I was wondering, if you could weigh in on just your seasoned view of this market psychology of the investors. Again, I can't help but notice, even from the cheap seats where I sit, that back in the first major drop days of the market, where we were losing, 1,000 here and 1,000 there off of the Dow, for example, we had big names come out right away, right from the beginning. Ray Dalio. We had Warren Buffett, we had Sue Zorman, we had all these people and heads of the Fed Bank of this and that and the other, all saying soothing, calming words about how this is very normal, and this happens in bull markets. You're going to get down days, and you ride them out, that sort of thing. So what I'm noticing is, and the term pump and dump comes to mind, but I'll just move on to later, after we had the sharpest downward 30% ever in the market, sharper than the 29 crash, sharper than the 80 crash and 87, sharper than any crash we've had in the past. Then we had people wondering, should we buy this dip and we'll be back to normal again? And that's when there were voices coming out. Now the head of J.P. Morgan's investing division saying, no, we're going to have this is going to be worse than the Great Depression. And all of a sudden it's like, what? Where were you guys after the first day? So now that almost seemed like bash and stash, and now here we are on a V-shaped recovery. So the people who knew that the Fed was going to step in how many different ways of how many different facilities, it just seems, again, from the cheap seats, that when things were starting to crumble at the top, we were told stay in, and when things were seeming to be really serious as they were dropping, then we heard the voices saying, oh yeah, now it's really serious, and now it's going back up. So is that, from market psychology, is that where a contrarian needs to basically do the opposite of whatever they're hearing the talking heads say from the officialdom?
I wish it was so simplistic. What I would say is that the whole of the financial system is really geared to its own preservation. You have to draw a distinction between financial assets and physical assets. And one which might confuse people is, what's the difference, let's say, between a REIT, what's it, REIT, Real Estate Investment Trust, and a property? I mean, like a physical property. Mm-hmm. Well, a physical property, you actually own it. A REIT, you just have some sort of vague entitlement to, usually a bunch of properties, but it's not specific. And there is a huge difference between the former and the latter. Now, the whole of the modern financial system is built up on financial assets. And those financial assets do not actually give you ownership of anything. It gives you something called equity in something, which is an undefined part of a bigger pool. And the whole thing is sort of really is buoyed up by a sea of money inflation. And I mean, if you properly adjusted the performance of financial asset prices for the expansion in the quantity of money, you'd really be losing all the time. But that's all part of the confidence trick, really. There's this sort of belief, it's a gambler's belief, if you like, that if I can just play one more time on the old roulette table, this time zero might come up and I might make a fortune. Yeah, quite. It does sometimes, but, it's not a good bet. And I think this is what people are really finding, that you can't really compensate for the loss of purchasing power of your currency by judicious investment in equities. I mean, they've gone just too far. Apart from anything else, the basis of the valuation is government bonds. In America's case, you're talking about U.S. Treasuries. Well, what should they be priced at? What's the rate of inflation in America? Is it really 2% as the, as shown by the Consumer Price Index, or under 2%? I mean, the answer is no. If you talk to anyone in America that you talk to, they say, well, that's not my experience. My experience is inflation's actually risen far faster. Right. And if you go to people like John Williams at Shadow Stats, he will confirm it by using his methodology, which basically is the same methodology that the statisticians in America, the government statisticians, used back in 1980 or was it 82? And then you go to Chatwood Index, which uses a completely different method of compilation, taking, I think it's something like 500 items, commonly bought items in each of 50 cities up and down the United States. And what do they end up with? They end up with more or less the same number. Inflation's running at about 10% and has been for some time. So, if you begin to realize that that is the truth of the matter, and this CPI thing is just a manufactured number which is completely meaningless, then you start saying to yourself, what should U.S. Treasuries be priced at? And the answer actually is it should be priced to produce a yield of 1 or 2% more than the rate of inflation, which I think privately we've agreed looks like 10%. Now that puts a valuation basis under the equity market, which is completely adrift from where we are today. So that's another way of looking at it. And there is a third way of looking at it, which I think is perhaps, to my mind, as I've sort of realized over the last couple of months, is probably the most important way of looking at it. And that is that the system of central banks has basically been using the printing of money to support asset prices. Now, this is exactly what John Law did in France with the Mississippi scheme way back in 1720. And you know what? There comes a point where you can no longer do it. When you start failing, not only do the prices of the assets which you've been fixing begin to collapse under you, but the currency goes with it. And when it does, it happens very, very quickly. And I think we're probably, if there is an identifiable point where the mechanism now starts for a total currency collapse, given that all central banks are about to print massively just to support their economies through the coronavirus, and also to stop all the supply chains falling apart, then we're looking at the destruction not just of financial asset values, but we're also looking at the destruction of the currencies in which they're priced.
Yeah, we have a question from Murphatudinal who asks, how can interest rates ever normalize if central banks buy everything? Will they stop once hyperinflation becomes obvious, or will they simply keep buying bonds?
Well, I think it's an extremely good question. The answer, I think, as far as the central banker is concerned, is that we'll just have to take on the market and we'll just buy bonds. But the thing they can't control is whether you and I, as individuals, and everybody we deal with, decide to continue to accept dollars or pounds or euros or Swiss francs or yen or whatever it is in exchange for goods and services. And if we say no, then that's an end of it. And that basically is where the central banks are driving their currencies. It does actually raise the question, what do we replace it with? Now, that's a difficult one.
Sure.
I mean, the answer is that you'll find that sound money does creep back into circulation, probably initially in a black market basis. But, so much is going to fall apart and change with the end of paper currencies. I mean, apart from anything else, the whole concept of a welfare state is out of the window because governments cannot afford to provide a welfare state. I mean, they should provide something because there is always this thing in life where people, through no fault of their own, have ended up in very difficult straits. And a civilized society does not tolerate people starving. Let's put it as bluntly as that. So some sort of welfare does have to be provided, but it has to be at a far lower level than what we've now become accustomed to.
We have a related question from Heike Frost who says, Alasdair, if the dollar's value will fall a lot in the future, would I still want to invest in equities at all? I hear some recommend gold stocks and foreign stocks, but ultimately, if I were to sell these stocks, wouldn't I still be converting into somewhat worthless U.S. dollars?
I think he's hitting a point because, it's all very well having mining shares, but at the end of the day, they're going to be priced in something. And if it's fiat currency and the fiat currency is worthless, then what's the point? I mean, there is no point. This is a very serious issue. I mean, somehow, sort of financial assets will have to get priced in something else. And, that something else, well, it would have to be something like gold. But then that changes the whole dynamic of everything. Because if you're going to produce a return in sound money, then that requires a definite return, which very, very few listed enterprises can actually produce today. It's a problem. It's a huge problem. And I really don't know what the answer to that one is. It's something which is on my to think through list, as it were. And if I come up with an answer, I shall write about it.
A related question back to the bond market. Justin Reynolds asks, can the bond market fail even if the Fed is now buying all the junk bonds? Can you take that in two parts? Explain to people what's going on with the purchases of junk bonds, and then whether that means that the bond market can be prevented from failing if that practice is continuing. Yeah,
well, this business of buying, sort of lower and lower quality debt is I think the eximious Dr. Johnson, who lived some 300 years ago, would have described it as the last refuge of a scoundrel, a scandalous central bank. I mean, they really are dredging the bottom of the barrel doing this. It is the ultimate end, if you like, in terms of trying to support a system which is falling apart. The system will fall apart through the currency becoming completely worthless. I mean, it doesn't matter, really, what the Fed does. It's not going to work. They're just driving their currency into extinction.
So we've got Jam asking, with all of the wealthiest countries working together to inflate the debt bubble, is it possible for one country to return to sound money practices without the agreement and cooperation of all the others? It looks like the fiat currencies are chained to each other, rising and falling together out of necessity.
Yes, well, we're talking about the end of the current financial system, and the idea that there's going to be continued cooperation between G7, G20, whatever, forget it. That's not going to happen. That's going to break down. It must break down. I mean, I look at it from the British point of view. We have this wonderful relationship with America where we do everything you tell us to do. Now, when the dollar starts falling apart, sterling will fall apart with it. Okay, but there does come a point where we are actually independent from American monetary policy. And when it costs, say, 10, 15%, whatever, for government to raise funds in the bond market here, the gilt market, then some bright spark, hopefully, will look at gold and say, well, hold on a minute. If we actually backed the currency with gold properly, put it on a proper gold standard, what I would call a gold exchange standard, in which case it's freely exchangeable by anyone, pounds for gold, gold for pounds, whatever, then our cost of borrowing would fall from 10, 15% down to 3 to 5%.
Mm-hmm.
Yeah, but in order to do that, we would have to achieve something else, and that is we would have to shut down almost all the mandated welfare economy. I mean, we're hearing at the moment about how wonderful the National Health Service is, which, I mean, don't get me wrong, the people in the National Health Service are wonderful, and just like people in the health service in America, they are risking their lives with this coronavirus. I think it is just amazing what they're doing. What's wrong is the system. The system is just overly bureaucratic and cannot deliver at anything sort of reasonable. It certainly can't deliver a free service, which is what we've got. If you make something free, then demand becomes infinite. That's quite simple to understand. But all that sort of stuff, it's just got to go. I mean, okay, we put in different arrangements for this, that, and the other thing, and every civilized society, as I said earlier, has got to ensure that the people who really, really do need some sort of life belt in life, as it were, do get some sort of support. That's got to happen, but not a general thing. And also the other idea of just printing money to finance wars. Mm-hmm. I mean, all this stuff in the Middle East is just crazy. All that sort of stuff has got to stop. The attitude towards the Chinese has got to change as well. I mean, am I really worried about the lack of democracy in China? Should I be worried? No, it's not my problem. But if China, on the other hand, makes goods that I actually want and desire at a price that I want and a quality I want, I should be allowed to buy them. We're moving away from these sort of fundamentals into a dystopian world where, anyone outside the country is an enemy, and also the people inside the country who want freedom are enemies. And, this is going to be a very difficult time from the point of view of society, which is already being rent apart by the coronavirus. And the ability of governments to fund these enormous payments. I mean, they're just running out of road. So the whole system is basically collapsing. And we're seeing this in the gold market, when hopefully one of your listeners and viewers might come up with a question on that. But the system is basically collapsing. So getting back to the basic point, I see cooperation between G7, G20, and all the rest of it as being a passing phase.
Well, something you just introduced there a minute ago about what a gold-backed currency forces you to stop doing, the craziness, is very interesting, because we had Wayne Jett on, who talks about if Trump were to want to, for example, go to a gold-backed currency, he would first have to balance our trade, because you can't have this chronic trade deficit where you're always sending more of your currency overseas. You'll be bleeding yourself dry of gold. You've got to balance your trade. And now you said you also can't afford this welfare state where you're paying everything for. So modern monetary theory, which basically has this, you can pay for anything by just printing more,
printing money,
seems to fly in the face of, if you want to have a sound-backed currency, you can't be doing that, because you'll quickly lose all of your money. And Ron Paul, always talking about getting rid of a warfare state. We can't be the policeman of the world, being everywhere, and because you can't afford that either if you actually have to live within your budget. So it's interesting. All of the realities return when you base your currency on something that's real.
That's right. Can I just come back on the subject of trade deficits? The trade deficit arises as a result of the budget deficit and the lack of savings. So if you get no increase in savings, your budget deficit ends up being a trade deficit. It's just a matter of national accounting. If, on the other hand, you're running a budget deficit and you're increasing savings, which is the case in some countries, like in some European countries, Eurozone countries, then you don't have a problem because the government is in effect funding itself from an increase in domestic savings. So a trade deficit doesn't arise in that case. America's problem, just the same as the UK's problem, is basically they've killed all the savers. Nobody's interested in saving. I mean, there's mandated saving in the form of pension funds who are now being robbed by the government. I mean, they really are. Through monetary policy, they're being completely robbed. So the answer is not to try and sort of stop the trade deficit, which is what Trump has been trying to do with tariffs and all the rest of it. Get your own house in order is really what it boils down to.
Turning our attention, as you mentioned, to gold itself, Clarence Hoover says, can a new currency backed by gold but not redeemable in gold inspire any confidence?
No. One answer.
Good.
No.
Talking about the supply of gold, that's been a grave concern of many guests on my channel recently. DB Stupid says, could we get into more detail about Russian central bank gold, Russian domestic miners, and Russian refineries? Why no Russian bullion market selling to Russian citizens?
Well, there's an interesting one. I have friends at the World Gold Council, and they've been talking to the Russians about this, the Russian central bank, and I'm not quite sure where it was left, but the Russians sort of, if you're a Russian citizen in Russia, then you pay sales tax on bullion. So, in other words, there's a tax, I don't know what it is, 20% or something. So, you're not going to get people to accumulate bullion. And I think this is a fault in the Russian system. It was recognized by the people that the World Bank, the World Gold Council were talking to, that this is something that needs to be changed. So I think, in theory, it's in the pipeline, if you like, for some sort of change. I mean, it could happen overnight. But you're right to point out that at the moment there's really very little interest in Russia itself amongst the public for gold. The only interest really has been the central bank, which has been replacing dollar reserves with gold. And that, I think, as much as anything, is for strategic reasons. Now, having said that, the central bank, Elvira, I can't remember what her surname now is, the head of the central bank, does seem to be quite Austrian in her economics. So that would lead me to suppose that she understands the importance of gold and of sound money. President Putin has been seen from time to time holding a bar of gold and sort of, which I suppose is meant to persuade us that he believes in it. Whether he does or not, I don't know. He probably doesn't give an awful lot of consideration to it. That's what the central bank is there for. The interesting thing is that Russia said the other day that they were going to suspend their purchases of gold for this coming month. I suspect that they feel that, I mean, if I was in their shoes, I'd be looking at this and thinking, that we have a supply and demand dislocation in the gold market at the moment over this coronavirus. If we're going to continue to accumulate gold reserves, then it is not in our interest at this moment to disrupt the global physical gold market. So on that basis, perhaps we should announce that we're suspending our purchases for the moment, and we'll review it later. And I think that's broadly what they've done, and I can see the sense in it from that point of view.
Could you, since you scratched the surface of that other topic, can you talk to us about the supply chain disruptions or the supply demand imbalance in the physical gold market right now globally? Yeah,
of course, this is being sold to us that, because the Swiss refineries, the 3 of the 4 large Swiss refineries have shut down. They're due to start, one of them, I think, tentatively reopen in the next next week or two. But we've been sort of sold the idea that the reason the gold market is in such a mess at the moment is because supply is being disrupted, and that can be sorted out between the CME, COMEX in other words, and the LBMA. And now they have issued joint statements. The LBMA has said that we've got plenty of gold in London, 8,234 tons or whatever the figure is. What they do not tell you is that the vast majority of that gold is central bank monetary gold. And not only that, but most of the rest of it is actually already spoken for in the form of physical ETFs, private ownership, and so on, which just happens to be in the London vaults, and so on. The true liquidity, the true available free float of gold is probably in the region of somewhere like 500 tons. It might be a bit more, might be a bit less, I don't know. So for the LBMA to turn around and say, don't worry, old boys, we've got 8,324 tons of gold in the London vaults, actually is being a bit economical with the truth. The problem has arisen. I think the way I'd look at it is in two different directions. I do know that the central banks have been supplying the market by gold leasing. And there was probably a sort of, if you like, a combined effort by central banks to bring stability into the paper gold market when we saw that open interest on COMEX ran up to very close to 800,000 contracts. I mean, obviously, there was a liquidity problem developing then amongst the bullion banks. The bullion banks' short positions were off the charts. They needed to have some liquidity in order to get the market back up and into some sort of normality. Now, they managed to contract that position from 800,000, it's just under 800,000, in fact, open interest, down to a current level of somewhere below 500,000. So that, in that sense, the operation has been successful. But two other things have happened. Firstly, in the public front, central banks have made it absolutely clear they're going to print money, like just crazy. I mean, so we've got monetary inflation in prospect. Now, that does change the dynamics of the pricing in the gold market. I'm not talking about tomorrow's price, but I'm talking about pricing if you take a 3-month view, a 6-month view. There is no doubt now the central banks have effectively told us, I mean, I'm talking about the big ones like the Fed, they've effectively told us that the gold price will rise over the next 3 to 6 months, and it will rise substantially. Why? Because we're going to print money like Billio. So that's the first thing. The second problem we have is one from the banks themselves, and an internal problem. The way a bank works, its bullion desk, I mean, this is when we call them a bullion bank, but it's actually a division usually within another bank. The way they work it is they will say to the traders, okay, you have got an allocation of, let's say, $100 million. You can run a book up to that. If you want to go over that, then you have to get authorization. And you must also get a return over the cost of funding, and let's say that's LIBOR or something like that. And once we've worked all that out, we'll work out your quarterly bonus. It's really as simple as that. That's the way they operate. This idea that this chap, what's his name, Jeff Christian, tried to say something the other day that actually the only way they can run a book is by covering it in on COMEX futures. I mean, that's a load of absolute rubbish. I mean, if you and I went in there, let's say we managed to get some capital together and we decided to run a trading position, then yes, that would be the case. We would be told that in order to borrow more money from a bank, in order to run a position larger than our capital, then we would have to cover it in the other market. So all we would be doing is we would be, taking arbitrage positions out of one market compared with the other and looking to reverse it later. But that's not what we're talking about. We're talking about trading books. Now, the reason this is important is that, firstly, management can see that the outlook for gold has changed. So they go along to their traders, who are probably in lockdown somewhere now, and say, now, hold on a minute, what's your position and what do you think the outlook is? Well, the answer comes back as being not all that terribly satisfactory, as you may imagine. The second thing is that you have got the financial controller. The financial controller has a big problem, and that is that liquidity within the bank is very, very short because of the liquidity squeeze. So what he does is he turns around to the traders and says, you know how we gave you an allocation of $100 million run positions? We're cutting that. As soon as you can get your position down, we want to see it under $30 million. So you've got a problem. And this is not happening in one bank, it's happening in all of them. So as you can see that, this is why suddenly the swap dealers have really got caught. They are almost as short as they have ever been in history. And then suddenly they get hit by a combination of these two things, liquidity being withdrawn internally and central banks, particularly led by the Fed and the ECB, saying we're going to print money until we destroy it. So they're in an impossible position. So what we're seeing actually is the whole of the paper system beginning to, well, you could put it this way, either crumble or alternatively you could say it is in effect being shut down.
Yeah, that's been just bewildering to many, even in the face of a serious illness, of which there are many and have been many throughout history. Why suddenly this time we're getting this coordinated official shutdown of the entire global economy. In fact, that was the headline of our last interview with you, is the whole of Europe is shutting down and U.S. and U.K. are next.
Yep.
What is your current view of the legitimacy of the necessity of the shutdown of economies rather than taking other preventative measures such as mask wearing or so on to deal with it? Why do you believe, A, that it was, and you're not a medical expert, that's okay, but do you think that that's even rational, that shutting down the global economies for an unknown period of time was the most necessary approach to a serious illness?
I think it's. I think the answer is partly or almost entirely political. Now that we have welfare states where the state looks after us and provides our health and provides this and provides that and all the rest of it, the state has got itself in a position where you get a pandemic, it's got the responsibility. So political responsibility is there, and it's really got no alternative but to, if you like, sort of pander to the myth that the state actually can provide everything you need in life and want in life and all the rest of it. So that's the first problem. The second problem is that when we went into this, I don't think that many politicians, many central bankers actually understood that already the global economy was in deep trouble. Mm-hmm. I mean, I've compared before on your show the situation today with that of 1929. Two things happened at the same time in both cases, and they had a synergistic impact between each other. One was after a long period of credit expansion, and the other was at the top of the cycle, top of that credit expansion cycle, the introduction of trade tariffs. In 1929, it was after the Roaring Twenties, and you had the Smoot-Hawley Tariff Act, which introduced extra tariffs over the Forney-Macumber Tariff Act of 1921, which increased those tariffs on average by around about 20 to 25%. In this case, we've had a far greater expansion of bank credit over a slightly longer period, from 2008 to 2019. And we've had perhaps slightly less impact when it comes to trade tariffs, really between America and China, though there was a certain amount of saber rattling elsewhere between America and particularly the motor manufacturers in Germany. Now, the consequence of that is that one actually does tend to reinforce the other, because central bankers look at their obligations, they look at trade finance and all this sort of stuff. They see things going down. They become risk-averse rather than greedy for more business. So we were already seeing this tipping down, if you like, into a bank credit deflation. So the production of money that we're now got to see has also got to compensate for that. So, in order to keep inflation going or prices up or stop unemployment rising or however you like to look at it. So we were already facing that crisis, and I don't think that this was very high on the agenda of any politician when it came to deciding how to deal with this pandemic. As far as they were concerned, And I think they're beginning to wake up to the fact that this is not the case. As far as they were concerned, we could shut down for a month or two and then just get back to normal very, very quickly. Mm-hmm. And so all government needed to do was to bridge the financing. Keep people in employment, pay 80% of their salaries for the next 3 months. Keep companies going. Tell the banks to allow them to run up overdrafts, and the state will guarantee it. That's the sort of thing we've got here, and you've got variations of it over there. But it is a 3-month wonder, and then we return to normal. Well, dream on. That's not going to be the case.
We've got one more question for you from Pablo Pina, who says, question for Mr. Macleod. As of now, has he adjusted his call of a collapsed dollar before the year end, or does he still remain on course? What can we expect to come from this financial trail before year end, and where to position ourselves accordingly?
I haven't adjusted my forecast. It will all be finished by the year end. What I've found, actually, is that developments over the recent weeks have confirmed that is increasingly likely. So that's that bit. What was the second part of?
Yes, is this what can we expect to come from this financial trail before year end, and where do we position ourselves accordingly?
Well, it is horrid. I mean, there's no two ways about it, and I think that the political reaction is also going to be even more destructive. For example, I can't see politicians resisting the temptation to put price controls on food items, for example. Now, I know that food is not shooting up in price necessarily at the moment, though it is in places. But politicians can't resist that sort of thing, and they'll basically screw up the supply chains even more. You'll find that there's less food, and therefore prices rise more quickly, and so on. So that, I think, is not a good outcome. I see social instability. I see genuine hardship extending not just from the homeless, but the whole way into the middle classes. It's not a nice forecast to make, the collapse of money. It really is not. But unfortunately, I wish I could think of a way of avoiding it other than, sort of sound money. I mean, sound money is the answer at the end of the day, but the trouble is that the politicians have to give up power in order to adopt sound money, and they're not going to do that willingly either. And where you've got a deep state, as in America, which is they're already looking at China and thinking, what are they gaining out of this? I get all these sort of vibes that they're sort of continuing with a financial war against China as if nothing had really changed. And it's not the right attitude for a government, if you like, to take when it comes to its relationship with its own people. It's got a fiscal responsibility, it's got a monetary responsibility, and it's not discharging those at all.
Well, Alasdair, you've painted, I think, a fairly grim picture, but a realistic one that we need to be concerned about, and I appreciate you helping our viewers and myself to see it from your eyes. It's always illuminating to us to get the perspective of someone who does as much considered research in these markets and economies as you do. Just thank you, as always, for joining us on behalf of all of our viewers here on Liberty and Finance and Reluctant Preppers.
That was my pleasure, DK.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.